Hey, welcome everybody to another eye opener. This Market Wealth Daily's quick little video chats that we do with top traders. We've got Keith Harwood back with us today, and I'm really excited. I'm always excited, but even today, so much more because there's a lot going on right now.
Yeah,
Just fresh news on the CPI. I want to get your take on that. I started scanning the headlines, and they're all over the place, good, bad, everybody's going to spin it one way or the other. We got
yeah,
the tariff announcement with China that some of the toughest tariffs are getting paused again. That could have a big impact. The futures, I mean, we're not open yet when we're recording this, and futures are starting to creep up a little bit.
yeah,
So interesting there. Really just kind of, want to see kind of what that means for everybody.
absolutely. Yeah, no, it's an interesting start to the day here, of course. We've got that CPI data that you mentioned. And so with that, the market is taking it with the bullish starting point. So pre-market, as you mentioned, we've got a rally going on. Now, the S&P 500 hasn't pushed to the new high yet this morning. SPY, as you can see here, is currently, or as of yesterday's close, was 635.92. On the pre-market, we're at 639.44. So the previous high, 639.85. We're really towing against that level. Big inflection point here. The question becomes, do we have enough news here to make the new high, or is this just another spot to fade the breakout? And ultimately, the technicals will decide. So the investment flow, the money flow is what we see in the technicals. So when I say the technicals will decide, it really just means the investment community, the money flow, the interest in buying a high will be illustrated by the technicals. We know that profit taking is likely here unless there's so much buying because we expect everything to work out as we've been trained to expect that we just push through and great. Then it's new high, bull market, everything looks really rosy. And frankly, with QQQ, the tech side of things, it looks better than the broad market. The S&P 500, that is, that includes a lot more sectors. Tech made a new high yesterday. 576.80 was the high. We're right at it right now. It looks like this market is going to take some of this news and run with it. It could be a false breakout. So I like to be a little bit cautious in those sort of scenarios, but at the same point, it seems like we're driving now into that bull market that personally I didn't expect to necessarily occur until we got maybe through the next month, because after non-farm payrolls, after the tariff stuff last week, it seemed like we were getting into a spot where, we needed that full 30 days to get to the next non-farm payrolls, to get some more clarity on tariffs. But we're trickling out some of those updates, as you mentioned, the stuff with China, that may be enough to say that people are confident that tariffs are all going to work out as we've been trained to expect. The CPI data tells us, okay, well, looks like we can raise interest rates. We don't have a huge inflation, or sorry, lower interest rates, excuse me. We don't have a huge inflation problem, so the Fed can act. Tariffs haven't done what we were worried they would do. So everybody's concern was that tariffs would cause major inflation. And as a result, we would end up with a situation where we couldn't lower interest rates because they have to fight inflation. And the way to fight inflation is to raise interest rates. But the way to spur the economy is to lower interest rates. We didn't have that scenario play out where inflation rose drastically throughout this whole tariff negotiation stuff, at least so far. And now I think there's greater and greater confidence that the Fed will act in September and that they won't have that hurdle of saying, well, inflation may be too high, we can't move. So the confidence in the market behaving the way that people want it to for a bull market is coming through now. And so broadly speaking, I think it's setting up for a potential rally. And, still like to define the risk, consider the possibility that after all of this, we do end up with something negative, because it seems to always happen that way. As soon as we get to the new high, okay, now we're going to take a shot at China tariffs, or we're going to take a shot at something else. Maybe it's another whatever conversation about replacing Powell as Fed chair. Any of these things can obviously cause a hiccup in the market. So I have to always consider the possibility that the bullish news flips bearish, even in the short term, causes a drawdown. And any long positioning I have then needs to have either defined risk or a hedge. And in my case, I like to use defined risk, as you know, by doing either call options for a leveraged directional trend type move, or as we talked a little bit about last week, put credit spreads don't need the market to go up. They just need the market not to go down significantly. So those are two ways that I can define my risk without having that drastic downside exposure that I don't want to expose myself to, just in case we do a repeat of March or we get a big dip, just like last Friday, where, sorry, not this past Friday, the Friday before on non-farm payrolls, where we dropped down 2%. And yes, it stops out long positions, but it doesn't do it in such a way that creates a huge drawdown if that pullback had continued.
Right. So really quick, so you mentioned put credit spreads, and
Yeah.
for me, for the longest time and a little bit now, I just kind of cringe a little bit. I'm like, oh, that's complicated. I don't want to think
Yeah.
about complicated. It makes my head spin a little bit. Is there a way to kind of boil this down to kind of make it a little bit more accessible to everybody who may not be familiar with a put credit spread? Just kind of walk through that, really kind of an overview of that for us.
Yeah. Actually, we had talked about this before, and then I had realized, I got to put something together this morning. So I actually put together a quick 3-slide thing for everybody so that we could kind of talk through the put credit spread relative to how it performs, how a call performs versus how a put credit spread performs. So when I'm predicting where a stock's going to find support and is unlikely to fail, I can use a strategy called a put credit spread. So in a put credit spread, I just want the stock to stay above my short strike. Now, if the stock rallies, I make money, but I may have made more money in a call. That was actually the example of Apple last week. It rallied aggressively. The put credit spread still worked, but an outright call actually would have performed better. But in the sense of something that's more consolidating, doesn't look like it has a clear trend to the upside, I can still sell a put credit spread, create some income without having to have a stock move a certain direction. And the benefit of that is it increases the probability of success. So what an actual put credit spread is a simultaneous short position in one strike put and a long position in a lower strike put with the same expiration. So I can give you an example here, and I'll show you a call relative to a put credit spread. If I have a $100 stock, the $100 call may be trading for $5 per share or per contract, which is $500. So if I buy the $100 call, it gives me the right, but not the obligation to buy the stock for $100 anytime before expiration. At expiration, I need the stock to be above $105 in order to start making money. But if it goes down or stays neutral, I lose $500. Okay, so there's a negative to it. There's this trade-off where if the stock doesn't go up, I'm actually going to lose money. I need the stock to rally, and I can get this great leverage as a result. If it goes to $115 a share, now I have a call option worth $15, and I've tripled my money. With a put credit spread on the other side, if I sold the $95 put, now I'm giving somebody else the right but not obligation to sell the stock at $95 a share anytime before expiration. So as long as the stock stays above 95, they're not going to exercise that because they could go sell the stock out in the open market. If it were trading $98 a share, I wouldn't want to sell the stock for 95, right? I'd rather sell it for 98. And if I hedge that or define my risk by buying a lower strike put, such as an $89 put, I've now created a scenario where I can define my risk to the downside and have very similar risk parameters to the long call for $5, where my max risk is the difference in the spread minus my initial credit. So in this case, collecting $1.55, the max value of this put credit spread is $6. That's the difference in the spreads. So my max risk is $4.45, a little bit less than the $100 call. But you can see that there's this nice window where I'm actually making money all the way down to $93.45. Below $93.45, I start taking a loss, but above that, I'm just making that $1.55, so $155 per put credit spread. That's where it really can kick in really well, higher probability of success, lower potential returns in that ultimate bull case, but I've got this nice big window where it outperforms a call. So anywhere between 89 and 105, 105, 106, actually 106 and a half, I suppose, because I'm collecting $1.55. I'm better off in the put credit spread. So I've got a big window to have a better potential return. And then above 106.55, I'm better off in the calls because at that point my profit is going to be higher. So if
And so,
I'm looking for a trade here, that it's built upon that idea that if I'm not bullish, I'm more leaning towards a put credit spread because I got a much bigger window of profit. And if we get that scenario where the stock rockets higher, I still make money. It's just, oh, I could have probably made more in a different structure, but there's always an optimal structure, whether it's instead of the $100 call, it should have been the $105 call or the $110 call. So, there's a trade-off every time we select a strike, we select a structure, but this is a bigger trade-off than just having a different call strike, and it gives me a nice window of profit.
yeah, so one of the things that always struck me about this, and I remember first starting to learn about the credit spreads and definitely put credit spreads, buying or so I'm sorry, selling a put always scared me a little bit.
Yeah,
Not completely unfounded, but not as uncontrollable as one would think. In this scenario, what you're doing is you're selling that 95 and you're buying an 89. So you're
yeah,
immediately covering that risk. So it's not like you're going to get caught, flat-footed, right? So you've got that, and that's what
yeah,
makes the spread, that gives it another kind of that downside risk control. You know what that is, and you don't have unlimited exposure on that. So
yeah.
that's great. Then it's that to your point as well, this kind of increased probability of success. You know, uh, a lot of times you see people just getting into trading and they think they're going to walk in the door and get the winning lottery ticket, right? And we just if you've been trading for any length of time, you realize that's not the way it works. Once in a while, you
Yep.
get a trade that does incredibly well. Even those, I'm getting a little bit old and cranky, and I'm like, you know what? It can keep going up, but it could just come right around and kill me. I'm just going to lock in the profit. I'm going to have my profit target, and I'm going to try to stick to that profit target and lock it. Foreign thought sometimes to people who are just starting trading because all they've ever heard is, oh, if I bought Google at whatever, I can make, I could be rich by now. They think that every stock, that every trade is just, that's what they're shooting for. And that's not the case.
Yeah.
In this case, you're generating high probability, very defined risk opportunity to generate income. So
Hmm.
that's the beauty of these spreads. And as you start to trade, you're going to get more and more familiar with everything surrounding us, placing an order for an option, tracking it, valuing it, being ready to exit when you need to, all those things. And then all of a sudden, the stuff that scared you initially about a credit spread or made it seem more complicated than what it was, kind of starts to dissolve. It kind of goes away. Now
Yeah.
it's just another trading strategy. So,
Yeah.
these are the kind of things that, and I know we've got some advanced traders, and thanks for bearing with me while I kind of back this down a little bit. But I also want to reach out to the folks that are kind of getting into this and might have just been doing directional trades, just kind of getting their feet wet and getting into the option market. That this is why there's so much potential here. And again, I repeat this in so many sessions. The tools that are available to us right now have made all of this stuff so much easier than it was even a few years ago. So that's why it's a little bit different. There's so many things that are available on all the trading platforms that help you value the credit spreads, help you place the spread trades, all that stuff. It's really gotten a lot better. So you can't listen to what people said 20 years ago and all that. You have to look at what's available now. It's really great. It really is an opportunity to generate some income using these
Yep.
types of tools.
Absolutely. And I think you touched on a couple of things that I want to point out here. So first off, the $89 put, effectively what it does is it reduces the amount of premium that I collect. Maybe I would have collected $2 for the 95 put, but it defines my risk. It puts a stop level on the trade. And that's why it flattens out here at $89 a share. Below that, I can't lose any more money because somebody else exercises the $95 put. I exercise the $89 put. So I sold the stock for bought the stock for 95. I sold it out for 89, and I got paid $1.55 on top of that. So I didn't lose the full $6. I lost $4.45 in that scenario. It's not what I want, but at the same point, when I buy a call, if we don't rally, I'm going to lose $5. And so I'm going to have a loss without a rally. I'd rather have a scenario in many cases where I don't take a loss unless we actually go against my trade thesis. One of the other things you mentioned was that desire to take profits. Now, a put credit spread naturally does that for me because it caps my potential profits. So if I start seeing the stock rally or just time passing, I'm making some money in that process. And so if I have a natural inclination to take profits, let's say it's in this $100 call, where as soon as we get to $107 a share, I want to take my profits. Well, if that's my profit target, why don't I just structure it with a put credit spread? Because I'm going to have the same return, roughly, with a much bigger window of profit. For those traders that, and I've had my windows where I've been on more on the very bullish case, and I want to try to trade for this 115 or higher dollar move, the outright call can work. But if I'm finding myself letting those winners run for a while and then they start to come back, where at first it got up to 115 and then pulled back to 107, and that's where my exit was, then actually a put credit spread can do better for me from a psychological standpoint, where I didn't give up this big return and then turn it into a small gain instead. So if I cap out my gain by having a put credit spread, I don't ever have that window where I get overexcited, maybe a little bit too optimistic about the stock's behavior, and I don't take my profit. And then I end up with a small gain or even a break even or a loss. Put credit spread in that scenario, if it goes up and then stops and then comes back down, I'm still collecting money the whole time, and I generate my max profit. So I don't have to worry about that continuation to the upside.
That's a really great point. And again, I alluded to it. It's a challenge as but for me, as I start to trade more, I've just had stepped in that trap so many times of, oh, look, it's up 50%, it's going to go higher. Oh, it's up 60%, it's going to go higher. You blink your eyes, and now what happened? Now I'm negative. How did that happen? What just
Yeah.
went on in front of my eyes? And you get crushed. And I'm like, man, I set a target at 40%. If I'd have locked it in, I had 40%. Now I got negative 20. This takes that risk of that emotional risk, that kind of
Yeah.
influence of emotion out of the equation. It's such a great point. Such an important thing to remember with this stuff. That's why
Yeah,
they're
exactly.
great tools to have at your disposal.
Well, and I mean, I think it's kind of interesting the way that, options structures are worked for, basically access to the markets. The first thing that we get access to when we're first starting into options trading is long outright options. And frankly, that's actually can be some of the most dangerous way to trade. Long outright options would be probably second most dangerous to short outright options. Spreads are the generally safest way to trade the option. They can seem a little complicated, and that's why they don't allow people to get into them immediately when they're first starting on the options trades. But they also do help define the risk and actually generate, in many cases, a much better profit window. So they're kind of the safer trades in general. Naked puts, shorting naked puts, shorting naked calls, that's the riskiest thing you can do, of course. But a credit put spread, that's one of the safer avenues in the options market that generates income as long as you understand the max risk. And I think that's the reason that they do that, is the max risk, of course, with a long call is the premium paid. And with a put credit spread, now you have to do a little bit of a calculation, understand the real window there. So I get it, but at the same point, I think that it's one of the more valuable tools for a person starting off into options trading to really get comfortable with, because it gives them just a nice big spot window for success.
Well, and so, we talked about it again too, about how the tools today make things so much
Yeah.
easier. They just do so much of the heavy lifting, the calculations and everything else. And I know you guys have spent a ton of time on the tools that you have available for traders. And I know that
Yeah.
those tools are really critical in helping find the right scenarios to apply a put credit spread. or other
Yes.
option strategies. But if you have that tool, now you're like, well, is this really the right opportunity for it? You can plug it in and let the machine do the work. It's not giving you a headache trying to do all the calculations.
Absolutely. Like, as you mentioned, 20 years ago, you got to look at the chart, you got to do all the technical analysis yourself, you got to do all this extra effort, you got to screen through a bunch of different stocks and say, okay, well, how do I vision this trade coming out? What's my rule for entry and exit? When I can go to AI, it does a lot of that heavy lifting for me. So, we've talked about the forecast toolbox before, and touching on that, the S&P 500 right now is actually projected to make that breakout happen. And I think that looks like it's more likely than not now, given today's information. But we'll see. And if that happens, a stock like Expedia is projected to have a really bullish run here and could be a really good leveraged opportunity for that call trader. Now, we talked about a couple of ideas last week with like Microsoft potentially having that big return, and Microsoft didn't go anywhere. So that
Yeah,
created the loss.
right.
Apple, on the other hand, was off of our put credit spread. So I looked for another idea that was more put credit spread focused. As much as I like Expedia, I don't want to get into too much on the details on that one for the moment. And I want to focus on just going back to some old, faithful, strong companies. And Morgan Stanley looks like a really good one for me. So with the inflation data, it looks like banks and financial institutions should be in pretty good shape. And Morgan Stanley's not necessarily looking to skyrocket. So that's a good thing for me when I'm looking at a put credit spread. I don't want to get to a point where I'm thinking, gosh, am I leaving money on the table? If it rallies more, so be it. But right now, the math says, the AI says, the technicals say, it may not go skyrocketing higher, but at the very least, I've now got a setup where I think that over the next week or so, we should stay above 142. And then I can just go to my options market and look for a put credit spread. Now, first things first, I'm going to just point out that 142 is right in line with that 10 and 20-day moving average. And it's been a pretty middle of the range spot for Morgan Stanley. If a bull market's coming in, that mid-range should hold. We did dip below it on the non-farm payroll. So if things get nasty, I need to have that defined risk, because if we go down to 136, 135, I don't want to have a real major problem. But in the next week or two, if no news is really coming out that comes in bearish, I can collect a good amount of premium for a pretty good risk by selling a 142, 140 put credit spread. Now I structure this way because I say my model says we should stay above 142. So I'm proving my model wrong if we go below 142. The market is telling me that the model is not right anymore. But if the model stays and holds, that's my profit point. We go below 142, I start to wonder if I need to exit. But as long as we stay above, I can collect this premium, and I don't need a 10% rally in Morgan Stanley to make money here. I just need to stay where we're at and stay above 142. So as of yesterday, this 142, 140 put credit spread was 59 cents. It's got a 10 delta and up 60 cents today. So I'm going to expect it to be around 59 minus 10% of 60 cents, which is minus 6 cents, 53 cents this morning. So at 53 cents of credit, if we stay above 142, I make $53. If we have a repeat of non-farm payroll Friday price action, I can lose up to $147. But I have a nice high probability of success of staying above 142. So I have a high expected value here. And ultimately, I wouldn't necessarily be expecting the stock to drop to 138 immediately, but I have to price in that possibility. If we drop below 142, 141.75, I'm starting to get a little nervous and a little bit concerned that this trade may not actually come to fruition. And I look to exit before it hits that $2 value, maybe closer to $1. And if I can plan to have that exit at that price point, my plan is to risk about the same as what I'm expected to make, with a higher than 50% probability of success, but an outlier risk of maybe losing $1.50. So generally from the game plan, it's to stay 50-50, equal size risk reward. Understand that I can have as much as triple the risk to the reward, but I have at probably 3 times the probability of staying above 142 than going below 142. And that's where I have an expected value that's positive, is as long as I know that if we start to dip, I want to take my exit before it gets too bad. I generate that profit. And now we've cleaned out the option prices as we're getting a little close to the
Yeah.
morning bell here. But we have a nice profit window with that, and it's actually versus some of the other stuff we've looked at, like the Expedia, where if it goes to 220, yeah, I can make a ton of money long calls. But I don't
Mhm.
have as much emotion within Morgan Stanley. I wake up and I say, oh
Right.
gosh, Morgan Stanley's only up 2 cents today. I'm not going to make money today. Actually, Morgan Stanley's up 2 cents today. I'm going to make a little bit of money because as time passes, that put credit spread gets lowered in value. So,
And it's all about matching these tools to your strategy, to where you're at in the
mhm,
market, and understanding them as you have to adapt. The one thing that we have learned from this market, especially this year, is that it can do whatever it wants. And
mhm,
it has really broken a lot of rules this year. uh, Being armed with a collection of tools as opposed to just a couple tools really makes a big difference. We have seen this market sit in a kind of range lock zone where it just kind of hovers along. We've seen it do big drops. You just got to have the right tools for the right conditions. And you got to have the right tool for your risk tolerance, your risk profile. So knowing this stuff is really helpful. And then having the tools to help evaluate and find those and have them be available at the click of a button, that just makes all of this stuff kind of come together.
exactly. I mean, it comes back to, I always like to compare trading to golfing. Buying the long call and having it work, that's hitting a big driver off the tee. But where we
Mhm.
all tend to do the most damage or the most gain in our golf game is around the green. It's the short game. So it's that little stuff, the put credit spreads, the other complex strategies that really actually make a big difference over the long haul. Now, hitting a big drive feels great and sets us up for a lot of success in the future. But as you go through a full 18 holes, you count up your putts. You're expected to putt 2 times per hole and hit the driver, what, maybe 12 times per round. So you're going to use that putter a lot more often and find that that's a bigger potential way to save strokes than getting a little bit better with the driver.
Exactly. That's exactly it. Yeah, there's a ton of analogies we can use, but
Yeah.
really smart to just kind of get an understanding. And this is a really good introduction to that. So, Keith, thank you so much for that. I know the market's going to open. We'll let you jump, and
Yep.
we'll get this out to everybody and include the links to the toolbox there as well, so that they can have access to that. Just pushing a button and getting the information they need. But what a great, just kind of basic class on put credit spreads. Thank you so much.
Thank you.